Today, we're going to analyze Apple's stock and see whether right now is a good time to invest in the company for the long term. First, let's see if there's a good business behind the stock. Apple is projected to grow its earnings 11% per year over the next 5 years, while the S&P 500 companies are expected to do 17% over that same period. 3 points for Apple and 4 points for the S&P 500. Apple has a slower growing business. When it comes to profit margins, Apple gets 26% out of its business, while the S&P 500 gets 18% out of its 500 companies. 3 points for Apple and 2 points for the market. Apple gets more out of its business. I like companies that pay out a dividend. Dividends are the only thing separating a true investment from pure speculation. Apple pays a 0.59% dividend, while an S&P 500 ETF pays a 1.29% dividend. 1 point for Apple and 3 points for the S&P 500. Apple pays a smaller dividend. As it relates to the dividends, we want to know how much is being paid out to shareholders. Apple has a payout ratio of 15%, while the S&P 500 is at 22%. 3 points for Apple and 3 points for the market. Apple is keeping more of its money to reinvest and grow. Cash and cash equivalent is a basic measure of cash available for payouts, reinvestments, and acquisitions. Apple has $73 billion in cash available for those activities, while the companies that make up the S&P 500 have an average of $74 billion. 4 points for Apple and 4 points for the S&P 500. This metric benefits larger companies since they often command a higher economic value. Effectiveness is basically when you add the returns on assets, equity, and invested capital. Apple has an effectiveness of 242%, while the S&P 500 is at 58%. 5 points for Apple and 3 points for the S&P 500. Apple has a more effective business. How good is an investment if it never goes up? Looking at the past 10 years, Apple has returned a compounded growth rate of 25%, while the S&P 500 has compounded at 12%. 5 points for Apple and 4 points for the S&P 500. Apple is a better performing stock over those 10 years. I look at the PE ratio as a measure of speculation. When it's high, there's more people speculating on the stock. Apple has a PE ratio of 26, while the S&P 500 is at 23. 3 points for Apple and 3 points for the S&P 500. More investors are speculating on Apple. The PEG ratio takes into account the expected growth with the PE ratio. A PEG ratio under 1 is what we want. Apple has a PEG ratio of 2.4, while the S&P 500 is at 3.08. 1 point for Apple and 0 points for the market. Apple is a better value right now. The quick ratio tells us if the company can pay off its short-term obligations. A quick ratio over 1 means it easily can pay those obligations. Apple has a quick ratio of 1.02, while the 500 companies of the S&P is at 1.68. 2 points for Apple and 3 points for the S&P 500. Apple is less likely to pay its short-term obligations relative to its debt. While many investors look for a higher 200-day simple moving average, I look for one that's lower because it means more value. Apple has an SMA 200 of negative 6.2%, while the S&P 500 has an SMA 200 of 13%. 4 points for Apple and 2 points for the market. Apple's stock is lower than normal. Short float tells us how much are investors betting against a stock. Apple is short 0.73%, while the S&P 500 is short 1.08%. 5 points for Apple and 4 points for the S&P 500. Investors are betting more heavily against the market. The average Wall Street grade from a strong buy at 1 to a strong sell rating at 5. Apple has a rating of 2.18, while the S&P 500 has a rating of 1.7. 3 points for Apple and 4 points for the market. Wall Street is less bullish on Apple. This last metric is income divided by the number of employees. Apple's employees each have a value of $626,000, while the average of the S&P 500 is $305,000. 5 points for Apple and 4 points for the S&P 500. Apple employees produce greater value for the company. Adding everything together, Apple has 47 points and the S&P 500 has 43 points. Divide each by the maximum of 70 points. Apple has a good business with a grade of 67.1. Compare with the S&P 500 at 61.4. Both have good businesses behind the stock. Apple is just a little better. Before we get to Apple's final grade, join my Patreon and get access to every company I've analyzed so you can compare between all your favorite stocks. It's updated all the time. Go to patreon.com/GrowthShares or click on the link in the description. But of course, we can't forget about Apple's fair price and whether it's the right time to buy the stock. I use a discounted cash flow model taking into account a 10% margin of safety. That translates into a fair price of $140 for Apple, which is 18% below its current stock price. When we look at the table, we can see that Apple's stock is overvalued, giving us 20 points. So if you're only concerned about the stock, wait until it drops further. Finally, we can put everything together and get Apple's final grade. With a business grade of 67.1 and a fair price grade of 20, Apple has a final grade of 62.4. That means Apple is a good long-term investment if you were to buy the stock right now. However, I'd hold off until the stock gets cheaper before I jump in. So what are your thoughts? Are you going to invest in Apple? If you do, invest wisely, and as always, take care of your money.